Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Paul Sweeney. Join us each day for insight from the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.
This is some of my Ute folks. Good morning, Samuel Coffin, the fabulous Maury Harris of UBS, who built all the foundation there.
Payne Weber originally.
He hired years ago this young whippersnapper, Drew Matus. And what's cool here is someone like Matus folks now over at MetLife. It's like Juan Soto. He went from the Padres to the Yankees. Over with the New York Yankees, Drew Matus gives me a research report from 8 years ago. Drew Matus, why are you pulling out a UBS report from 8 years ago, my three favorite canaries? Tweet for us.
There's still some of the best things to look at in terms of whether the economy is improving or getting worse. And unfortunately, what we're seeing in those indicators, which are claims, the ISM reports, and core bank loans, are all signs that the economy is beginning to weaken, which I think has become more evident in things. But, with the idea of kind of the soft landing having taken hold or the no landing having taken hold, this is just something that I think points in the opposite direction and maybe suggests that, weakness is going to be forthcoming.
Will we finally see it in the jobs report coming up here early June?
I think we're going to see some weakening in the jobs report. Our expectation is you're going to see the unemployment rate move higher over time. Once again, we do expect the Fed to cut interest rates, but we expect the Fed to cut interest rates because we expect the economy is going to be weakening. They're going to be cutting with inflation above their target.
June 7, a late jobs report, Paul Sweeney. Change in non-farm payrolls now 180,000 is the survey.
So, Drew, do you think the Fed here, do you think the Fed's kind of behind the curve a little bit here in terms of cutting interest rates? Or, a lot of folks will come in here and talk to Tom and I and say, hey, they should just wait here. How do you think about it?
I think there's an argument for waiting, but at the same point, the Fed's pretty much always behind the curve. There's no point in putting, a dachshund, against a greyhound and expecting the outcome to be any different, right? The Fed is the animal that they are, and they're going to be behind the curve. And the question is, how aggressive can they be when they don't know where things are going? And I think the answer is that they need to have a little bit more humility, which, I think if they had that in the first place, we probably wouldn't have had the inflation rates that we've had.
All right. So given that backdrop here, again, rates likely coming down at some point. Earnings seem to be pretty solid here. That seems to be pretty constructive background for equities. How do you guys think about that?
The problem is kind of, how much risk do you want to take when it seems like we're on the verge of a turn? And where will that turn show up? And will it be as obvious to everyone when it happens? We've been in kind of a risk-off mode for a while now, and I think that's served us well. And I think, that's probably where I would still be. Although I will say, when you're trying to figure out at the turn where you're going to be, there are places you can be where you actually, as soon as the turn happens, you want to be looking at those places. And so, we're trying to be or thinking about things in a more nimble way. And see, where the greatest mispricings are in the economy.
Drew, back to Colby College economics of a few years ago in your sterling career, there's a whole idea of aggregating all the data together versus 2, 3, or even 4 Americas. Are you disaggregating now? Are you looking at an America of haves and have-nots?
I've always been a fan of keeping the aggregate. And the reason being is because, if you disaggregate it in that way, you're basically saying that one group of people can't do a job that another group of people can do. And I think increasingly, We're seeing actually that, with new technologies, people can do things that, maybe they weren't possible before. The only reason to disaggregate now is because it seems like, the savings rate among one group of the higher end cohort, income cohort, is really strong, and there's some excess money there. And so we need to be, if we're going to see weakness, it's going to be there first, right? We already know there's weakness in certain other areas. But the people who drive the economy are the people who can change their savings rate. So, if people are going in and they're getting either government support or they're spending 100% of what they make, those people don't have the ability to adjust their spending. They just adjust what they're spending on. The higher income cohorts have the ability to actually, increase savings, decrease savings, which then boosts the economy or reduces the economy. The good news for the Fed, quite frankly, is 10-year yields are basically at the optimal point to maximize spending.
Interesting. Where are they going to be in 12 months? I mean, that's the ultimate call. And
so we actually think they're going to be relatively stable around here. But, once again, though, if they go higher, people begin to save because they feel the need to. If they go lower, they actually need to save more because people think about retirement and they think about the yield they're going to get in retirement. And so they adjust to try to basically get to an income stream in retirement. And that's the failure of the zero rate policy, is that if you push rates too low, it actually inhibit spending.
Drew Matus, thank you so much. With MetLife. Greg Daco joins right now, EY Parthenon. Greg, it's a, quiescent maybe doesn't capture it. It's sort of an on-plan report, but 1.3% real GDP, is that on the edge of stagflation?
No, I don't think it's on the edge of stagflation because of the composition of this GDP print. What we saw was, again, a very large trade drag, a drag from higher net imports. That is not necessarily a bad thing. It indicates that there was still demand from a consumption perspective, from a business investment perspective. So I think I would fade the headline GDP print, which is soft at 1.3%, and focus on final demand from private purchasers. That is still trending around 3%. It's still a robust economy, but we're seeing a little bit more scrutiny on the part of consumers in this high cost environment.
Yeah, but this is religion to me, folks. We're talking domestic final sales as a general statement. It's something you flunk in Econ 101. Greg Daco didn't flunk it. But the answer is you peel out exports, you peel out the noise, maybe you peel out the silliness of inventory dynamics, and you got a run rate in America that Paul Sweeney sees every weekend of like a 3% GDP, right, Greg?
Yeah, you've got about 3% GDP growth when you peel out all those factors. I would also note that today we got the GDI report, the gross domestic income number, which rose 1.5%. So even though you have to nuance some of the underlying factors in terms of the headline GDP print, gross domestic income continues to point towards that softening momentum in terms of the economy. If you look at consumer spending data, also showing consumers exercising more scrutiny, being more careful as to what they spend on. And you're seeing the lower income consumers, younger generations, consumers that are more indebted, that are feeling the pressure of high interest rates and high prices and curbing their outlays in this environment. So that's what I would expect to see as we navigate into the second quarter.
As we do on surveillance, we go to the younger generation. Lisa Mateo, are you curbing your consumption?
I'm trying my very best. It's just not working out
going
very
down
well.
in flames at it. Thank you. That's the last time we'll speak to the younger generation today. Paul.
Hey, Greg, talk to us about kind of your view of the consumer here. I'm just looking at some Kohl's numbers that came in weaker than expected. Target was also a little bit weak, but Walmart was okay. So, I mean, how are you guys viewing the consumer out there?
I think we have to depart a little bit from this view of the consumer. I think there are multiple types of consumers, and we're increasingly seeing a bifurcation in the economy. We're seeing individuals at the lower end of the income spectrum, those, as I just mentioned, that have higher debt burdens, that are perhaps maxing out on their credit lines, that have larger debt amounts and perhaps less savings to buffer any type of slowdown in the labor market. Those are the ones that are a little bit more careful, more prudent with how they spend. that is gradually moving up into the income ladder. And if we do see, and I'm not saying this will materialize, but if we do see a more pronounced slowdown in the labor market, that could portend to slower income momentum and in turn force even a more pronounced slowdown in consumer spending activity, which by itself would actually be a good thing on the inflation front because it would promote those disinflationary currents that we've been seeing.
All right, Greg, given that backdrop, do you think the Fed should be cutting rates now? Or like a lot of folks say, they should just be sitting on the sidelines and wait? What do you think?
I think a lot of attention, perhaps too much attention, has been given to this first rate cut. Nothing says that once the Fed starts to cut, or the ECB, or the Bank of England, or the Bank of Canada, they have to cut at every meeting or every other meeting. Nothing is predetermined in this environment. But I do think that if you look at the broader picture and have more of a forward-looking perspective with this view of the economy gradually slowing, disinflationary pressures still in the works, the Fed could very well start easing monetary policy now, take some time to evaluate how the economy is evolving, but be on the right step in the case the economy slows faster than what has been expected. We've been riding this good wave of robust economic data, painless disinflation. I think we have to be very careful to assume that this will continue forever. We are seeing signs of cost fatigue, high interest rates, more cautious business investment starting to weigh on the economy, and we have to be prepared.
And now, folks, home economics with Gregory Daco, EY. Greg, this is in the zeitgeist right now, and some of us are living it. I'm going to be an amateur here. Renters insurance is in CPI, but homeowners insurance sort of kind of like is not calculated in CPI. And I go to CPS reporting 4, 5, 6 months ago, the basic idea that 90% of the homes in New Jersey's Ocean County and nearly 60% of the homes in Monmouth County are at risk of higher insurance premiums. We go to our New Jersey premium expert, Paul Sweeney. What premium is homeowners premium right now in the premium state of New Jersey?
And I'm a solid 5 blocks from the beach, so I'm paying my fair share. My former home in California, Tom, it was in a fire area. So I was covered with regular insurance until about 3 or 4 years ago. And they said, nope, you're now in the fire area. So I had to go to Lloyd's of London to get insurance.
Did you?
Yeah. I mean, those are the people that insure ships that go like in the Red Sea.
Did you stop by Greg's and have an onion and cheese?
Exactly.
Greg Daco, this is ridiculous. Homeowners insurance, a guy like Michael Barr has been crushed with 6 deer in the backyard from homeowners insurance. Greg Daco, how do we put homeowners insurance that we're all getting killed on into CPI?
I think we have to be very careful with insurance in general, both homeowner insurance and car insurance, and wonder whether these are the types of pressures that the Fed should be fighting. Should the Fed be focused on these components of CPI inflation, of inflation in general, as to essentially try to curb inflation and bring inflation back towards that 2% target? There are open questions as to whether the Fed wants to squeeze other components to offset the fact that
they can't control that. Come on. There's no textbook you or I studied that says the Fed can surgically control selected inflation items.
Exactly. And you probably, given the blunt tools and the uncertain lags in terms of monetary policy, that's why I'm not necessarily sure that you want to have monetary policy remain higher for longer, tighter for longer in this type of environment where a large part of what's driving inflation today is structural by nature. Homeowner insurance prices are not rising because of inflationary dynamics, rather because you have climate change, you have conditions that are shifting. Same on the automotive front. Not necessarily sure that the Fed can do much about these types of inflation dynamics.
On this anniversary of the release of Just What I Needed by the Cars from Boston University and EY. Greg Daco, thank you so much. Just absolutely brilliant there. This timely interview coming up, we are going to consider the legal issues of Lower Manhattan. David Gura there. I think June Grasso's. Is June scheduled to be with us as well? Did we talk to her people? Are we? I think
she does the afternoon shift.
Yeah, I don't know.
We got David Gura. He's going to be in studio here.
Right now, Aoifinn Devitt joins, Chief Global Strategist, Moneta Group, with a really, really solid understanding of the turn of markets out of the United Kingdom. Aoifinn, thank you so much for joining right now. Can we sustain global nominal GDP? Can we keep this good feeling going?
It's going to be difficult to sustain that. I mean, we clearly have exceeded expectations in terms of where GDP has been, coming down to 1.3%. I'd say that's in the category of nothing to write home about right now. So that definitely is more muted and perhaps more in line with how the economy should feel after it's just experienced a soft landing. We know that it's quite mixed, so that number as a top line number, will perhaps distort quite a bit of variability behind the scenes among different sectors. So no, I'd say we're pretty much holding on by the skin of our teeth to a positive number right now.
How do you define stagflation? Do we know how Jamie Dimon defines it, Paul? I don't think we do.
No, he's still building a big building on Park Avenue.
People throw this thing around, and I mean, we're talking here with somebody with some qualifications, including Trinity College Dublin, a school called Oxford. She's done pretty INSEAD in France. I mean, even how do you define stagflation?
Well, I suppose I would like to say I was born in the era when it was last popular. Stagnation plus inflation. That's my understanding. It's been forecast for most of my life, but it hasn't actually transpired. And I'd say now we're hardly on either side of it. We're seeing neither stagnation nor are we seeing persistent inflation any longer. So I'd say that term has perhaps lost its purpose just at the moment. We have other problems certainly ahead of us, and that is how we deal with perhaps not having had this fallout, not having had this recession. How real essentially is this growth? You mean, and how sustainable is that? But I'd say inflation for now is somewhat in the rearview mirror.
All right, if that's in the rearview mirror, Aoifinn, as a chief global market strategist, where do you see opportunities on a global scale?
Well, it's interesting. We've always been global investors, and that has been a very difficult position to maintain because we have had high conviction outside the US, even at a time when the dollar was strong and there was persistent underperformance. So what we are cheered to see is that there has been this broadening of the market strength. And we still see that, even though that there's been a comeback in the last few days. We can see that there has been a broadening beyond tech, a broadening beyond large cap only into mid cap, into small cap, and certainly beyond the US. We've seen some decent performance out of Europe, decent performance out of the UK, finally, after lagging for about 14 months there. And then, of course, stellar performance from Japan and resurrection of hope and expectation around China post-COVID and post some of that overhang. So I'd say we're seeing this kind of commonality now of themes on a global basis. Where do we see opportunity? We see it in the divergence, in the fact that the dollar cannot stay long forever. We've seen some weakening there. We start to see divergence among central banks and how they're likely to perform, who's going to go quickly. When I say perform, I mean what they're likely to do in terms of the interest rates. ECB likely to go before either Bank of England or the Fed. That's leading to some divergence, which will manifest in the currencies. So that's where we're seeing it. And then, of course, you have single stock areas like, say, the Novo Nordisks of this world that clearly are stellar success stories. And if you do not have global exposure, you do not have the optionality that exposure to that would give you.
But I think if I were a portfolio manager, even, I think I'd be very lazy. I think what I would do is just go buy big tech and then stick my head in the sand and hope for the best. I mean, and that's kind of worked for me, I guess.
We should never underestimate what's sitting in a room and doing nothing, I think, which has always been perhaps a good response and riding out some of this volatility. The problem with that is this is a momentum trade, and chasing momentum has often ended in tears for investors. So we have not been too tactical, tried to be too clever around this momentum. We're even seeing signs of that spending is highly selective right now. That if we look at CapEx beyond spending, say, on cybersecurity and on tech or on AI investments, CapEx is actually coming down in other areas. So that's the story for corporates. That's the story for consumers. We see that in the Salesforce numbers, in the American Airlines numbers. And it'll be interesting to see what Costco comes out with today. But I suspect on the food side, people are still spending well. Yep. But selective spending is the order of the day. So there will be some cracks in the AI thesis because, quite frankly, no one really knows where we're going with this in terms of its impact. There's a lot of hype and momentum. Right. So all in there would be a precarious position.
Across a kitchen table. And Aoifinn, I mean, if in the United Kingdom, you've brought in some Greggs, the cheese and the onion roll, and you're there with tea, not coffee, I'm sorry, brown stuff. But Aoifinn, if you're there across a kitchen table right now and you've missed this equity surge, How do you get into the market into the summer of 2024?
Great question. Well, first, you get in how you always get in, which is gradually and staggering entry. And I don't mean staggering as if you consume too much of that ale, but staggering in the way we all dollar cost averaging, and that is, of course, how you do it. You definitely want to have that spread out around the time of a geopolitical event. We have elections in the UK on Independence Day on the 4th of July. There'll be elections here in early November, in the US in early November. So clearly we need to be mindful that those events are likely to cause some volatility in markets. And we're already seeing that in the volatility in fixed income. That will manifest in equity markets. So you stagger entry, you then make sure that it is broad-based across sectors. You don't try to be too tactical, because ultimately we can't predict where different sectors are going to be. Right. But we do know that certainly by the way passive is performing, that is certainly a broad-based exposure is the way to be.
Aoifinn Devitt, thank you so much. Chief Global Strategist, Moneta Group. Just love to have her on this morning. You take a look at the front pages. She's never been in a Golden Goose, but boy, does she have some newspaper stories today.
Nor will I ever wear those. Good morning. Yeah. All right, we're going to start with this story that came out yesterday. The New York Times, CNBC reporting Nelson Peltz no longer an investor in Disney. You remember the battle to get on Disney's board, right? He controlled $3.5 billion in Disney stock. So this is kind of taking that pressure off Disney. So a big part of his chunk was owned by Ike Perlmutter. He's a former chairman of Marvel Entertainment. So sources are saying that Peltz has now sold off his portion of those shares. But here's the thing. I mean, he's not going away empty-handed, because Disney stock's risen about 15% in the past year. Sources are saying he sold his Disney stock at $120 a share.
Nice. Paul, jump in here. 10-year return on Disney is 3.75% per year for the last 10 years. What Peltz got out of this with a profit, right?
He did. It was amazing.
Did Iger get out of this with a profit?
Well, it's still to be seen. Al from Jersey, I'm not sure if he came out with a profit either. But again, this is just a real challenging issue for Disney and for the media industry in general, Tom. They're trying to figure out, how do they make a business out of this streaming stuff?
I've always said this from day one. Lisa, help me here. They all came out with this streaming, and I'm about ready to cancel 2 or 3 of them. I mean, and I'm going mental this weekend. But the bottom line is, Disney, I look at, is, okay, Star Wars and lots of Cinderella and all the rest for kids. What does the new Disney look like?
I think the new Disney looks like a theme park company with some media assets.
No, but I mean the streaming service.
The streaming services.
When you look at the chiclets on your TV,
well, you have
I know Hulu, I know Netflix. What's Disney?
Well, The Mandalorian is their big push too. I mean,
that's Star Wars.
Out.
Yeah, it's all their franchises. They're going to try to milk their franchises, as they should, because they have the best franchises in Hollywood. But even that, they've seen some pushback on some of their franchises, that maybe they've overdone it, oversaturated it, so they pushed some of those movie releases back. But Nelson Peltz, he made a couple shekels on that investment.
Yeah.
Next.
Okay, you know that big, ginormous residential tower at 432 Park, okay? It's tall, it's thin.
The terrible shadow of the Central Park. If you're lying in Central Park.
Shortly the tallest residential building in the Western Hemisphere, okay? It had people like Jennifer Lopez lived there, okay? So it had this big reputation. But now apparently it's going through some problems. It had a 2021 lawsuit, that condominium board that says there were noise issues, leaks, malfunctioning elevators. So the problem is that a lot of the people who owned are now trying to get out of it, and they're lowering their prices. So since the lawsuit, there's been a number of units for sale, homeowners unloading properties for a loss, even would-be sellers cutting prices.
Well, I'm looking for a unit there for Tom Keene. The building's penthouse.
Yes.
The building's penthouse was recently discounted to $105 million, down from the original asking price of $169 million. So I think we're getting down into the TK level here to get the penthouse, which does have phenomenal views.
What's great about it is, if you're there, and I can take the Aston Martin across the street to the Aston Martin dealership.
Yeah, perfect.
There you go.
It's convenient. But this building, for those of you across the nation, this building is on Fancy Park Avenue, right down the street from James Diamond's new tower, and then farther up from Griffin's tower to be built over the next 6 years. The other towers, Paul, are sort of in the middle of nowhere on 57th Street.
I don't get it. And again, if you're sitting, if you're literally lying down in the Central Park, catching some rays on a summer day. The sun will be blocked by some of these buildings. It's just ridiculous. I mean, it
changed the whole landscape of the skyline, too.
It did.
Don't get me going.
Yeah.
I'll get in trouble.
Oh, no.
Exactly.
Next, let's move on, Miss Mateo.
All right, so how about this? Apple looking to kind of set aside its rivalry with Android because they want to put Apple TV Plus possibly onto Android. So this is a big thing. Bloomberg is saying there was a job posting that shows they were looking for the senior engineer to help build a television and sports app for Android. And the reason is because it competes with the iOS platform. So this is a big thing for Apple to go onto an Android.
Yeah.
So that's what they're talking about. But Apple TV Plus never talks about how many subscribers they have or how much revenue, but Android could really give it that boost because Android actually has more users globally.
Is that right?
Than Apple.
See, in the Sweeney household, we have one of our offspring is Android, and the rest
Just
are Apple.
one?
Yeah,
like
just
one.
And so he's shunned.
Outcast?
He's not in any of the group chats because
his income is 3 times higher than everybody else's.
Yeah, he's at Lockheed. He's a rocket scientist, and he says it's superior to iOS, but we just look at him like, what are you talking about?
Yeah, I get the same thing. What's interesting about this, Lisa, I'm so glad you put this in here quickly. Paul, this thing coming up in June with Apple.
Yeah.
And I think the bombshell is going to be with Google. That's my
absolutely. Yeah,
that's my amateur prediction.
And as Tom's referencing, they have a developer conference June 10th for Apple, and a lot of folks are saying this is going to be the AI event for Apple.
One more quickly. Next.
Yes, sure. Screen time before bed. When do you turn off your screens? Is it like an hour, 2 hours?
No phones in the bedroom.
No phones in the bedroom. Good for you. Okay, because there was that rule, maybe 2 hours before bed to turn it off because it can. The problem is that it suppresses melatonin, so it doesn't let you fall asleep as easily. But now there's studies saying that might not be true. So some people could be more sensitive to the blue light than others. They're saying it varies depending on person to person. So you don't have to follow that rule if you want. There are some strategies. Here's what you can do. You can set an alarm on your phone so that it goes off when you have to go to bed. You turn off your notifications at nighttime. I know my husband's notifications wake me up in the middle of the night. I hate it. It's annoying.
Please.
And you can keep a sleep journal, Tom.
A sleep journal.
Sleep journal. Yes. You can say what works and what doesn't work for you so you can get some better sleep. Track it.
You can't even say it with a straight face.
No, I can't.
Because a sleep journal. Thank you so much.
This is the Bloomberg Surveillance Podcast, bringing you the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.